Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. We're going to talk about oil and natural gas. It's still one of my favorite sectors. In this one, we're going to talk about discoveries and some other things related to oil and natural gas. Um, so we'll dive in here. Again, this is just my financial opinion. I grabbed this from some articles off oil price and some other areas. And I want to talk about we're using far more oil than what we're finding. So obviously, on the long term, that is not sustainable. Oil is the king because it has high energy return on investment. It's portable and easily storable. Very hard to find all of those characteristics. Electricity, you have to store it in batteries, you have to store it in all this stuff. The fossil fuels are superior at the moment because they're very easy to store. You can put it in a barrel, you've got a ton of energy, it's very energy dense, easy. Same with natural gas, you can store it very easily, and same with uranium. The electricity movement is a lot harder because you have to either one, we don't have the technologies developed to really store this stuff in high energy density storages, something like batteries or hydrogen. And hydrogen takes a lot of energy to make it. So it's just an energy sink. You're losing energy storing it as hydrogen. That's the downfall. But let's dive in here. I'll tell you what I've got here. It says global oil and gas discovery set to hit 75-year low in 2021. As of the end of November, total global discovered volumes this year are calculated at 4.7 billion barrels of oil equivalent. Liquids continue to dominate the hydrocarbon mix, making up 66% of total finds, and the monthly average of discovered volumes this year now stands at 424 million barrels of oil equivalent. So here is a graph. It's by Rystad Engineering here. It says global discoveries for 2021 on course to lowest in decades. November volumes, this is million barrels of oil equivalent. You can see that this thing is overall going down some. And this, we're only looking at the right-hand tail here. I'll show you what the world discoveries looks like in the one below it. The red is gas, the blue or the green is liquids. So liquids is here and gas is here. Liquids, Mexico, Malaysia, Brazil, Australia, Norway, and Colombia are the ones that are having the most luck in their exploration. Now, looking at the big picture view, this is what I like to look at. This is Colin Campbell back in 2012. These are projections here. It says the world oil discovery rates, gigabarrels per year. This is in what we have here, this is the oil demand in black here, this line. These are the discoveries of oil. And we are now entering a spot where we have deficits. We are using far more oil than what we are finding. And obviously that can't last forever. So this is the annual oil production has exceeded annual discoveries since the mid 1980s. Future discovery trend is much, much lower. You can obviously see that it is lower. And we were talking about million of barrels, that's 4,000, so that'd be 4. So we're down here. Yeah, we're down here. That's about where it's supposed to be. Looking at this, so we've got an oil problem. This is going to create an energy crisis, just like natural gas is creating one. What we have here on the right-hand side is this natural gas crisis. We can see this thing rolling on up in terms of price. We've got crude oil that's still very low, and we've got U.S. natural gas that is still very low. A lot of people, including myself, expect this to actually get pulled higher as the world runs into a gas crunch. And these are mainly countries that have high renewables, or they just have straight up energy shortages, like China. China has some natural gas problems. Japan. I mean, it's starting to spread everywhere. And my guess is it's going to spread here to the United States. That's my guess. As natural gas prices go up in other areas, it's going to draw natural gas from the United States to those areas because it is so expensive and so lucrative to sell natural gas to those areas. Now, one thing you want to look at when you're looking at all this is it's not just natural gas. What can slow down this movement? And a lot of people think that renewables can slow this movement down, that we're just going to build all these electric vehicles, that it's all going to be very easy to transition away from fossil fuels. My take on that is no, it's not. It's going to be very difficult. In an increasing energy environment world, it is much more expensive and much more difficult to get minerals out of the ground. Because one, we've got declining ore grades, which is more difficult to get out of the ground. And two, you've got an energy price that is rocketing higher. And I'm talking about natural gas, most likely oil will follow, and most likely electricity prices will move up with it. We also have shortages of minerals. One here, it says a graphite shortage could derail the EV boom. We have cobalt shortages, nickel shortages, copper shortages, all coming in the next 3, 4, 5 years, depending on what that mineral is. But copper is going to, we're eating through inventories of copper. We're eating through inventories of all these minerals. And the prices are going to rocket. They are going to rocket. This is going to be a massive commodity boom on a double front. What does that mean? The double front is we've got the commodity itself becoming not just more difficult to get out of the ground, but also our inventories are being depleted. So demand supply fundamentals will put this in a deficit, a market deficit. That would be copper, nickel, cobalt, graphite, all of them. Then we've got the energy shortage and energy problem, the crisis there that's driving energy prices higher, which is going to infiltrate its way to much higher producer price index numbers, consumer price index numbers, because it's one of the largest inputs for a lot of these companies and obviously mining companies. Here it says Europe faces a full-blown energy crisis as prices smash all records. A shortage of natural gas, nuclear outages, declining wind power output, and cold weather boosted power prices in Europe this week. The price at the Dutch TTF hub soared some 10% to 165 euros per megawatt hour. France's EDF restarted fuel burning generators as it halted 4 nuclear generators. They're burning everything they can. I don't see how the mismanagement here is so great that we are going to emit so much more carbon because we put in these wind turbines and solar. The worst thing that we could have done is put this stuff into mix the way that we did it. I don't know if it actually cuts down emissions. I don't know if solar does or wind. I don't know if anyone's actually done the actual math. I don't know if us pulling out batteries and doing all this electricity storage actually cut emissions. I'm not exactly sure on that. Be fun to see what the numbers actually are. This is the Netherlands natural gas. This thing's just gone vertical. It broke out of its little pattern here and it shot vertical. We've got the European natural gas underground storage inventories. This is zero. We are projected to go right at zero for 2021. I don't know where this thing's going to end up. We'll find out. Hopefully they don't hit zero. It's going to be really, really close. And that's why prices are going vertical, because whenever you draw your inventories close to zero, prices move in a nonlinear fashion. And keep that in mind. When you get closer to zero inventories, prices move in a non-linear fashion. We're seeing that in real estate. We're seeing this in natural gas. We're going to see it in oil. We're going to see it in copper. We're going to see it in all these things. They're going to move in non-linear fashion. It's going to be okay. What the heck just happened? That type of movement. Here's German power prices. You think that's going vertical? Sideways, vertical. It's moving on up. It's massively higher. We went from 40 to 400 over this, basically, little over, that's 1 year, actually. It's 1 year. It's ridiculous. Here's the crude oil inventory weekly moves for 2020 to present time. The orange ones are decreases, the blue ones are increases. So we increased during the C19, right after we were increasing. We got to 100 million barrels. And then guess what? We've drawn this all the way down. And if I'm reading this right, this is oil going into inventories. This is oil being drawn from inventory. And we're drawing from inventory in usually a weak time period of the year. So we're going to see what happens next year, next summer and spring, and how this all plays out, because the dynamics are quite, they're there, and they're quite complex. So that's what I've got for today. That's what I wanted to show you. The takeaway is we're using more oil than what we have been finding, and that can't go on forever. Something has to give, and we're going to hit shortages of anything that we go for going to alternatives. So when we go to alternative, it's going to be like we're short, we're short, we're short. So I think what's going to happen is we're probably going to not use it. So the prices will go up, and people are just going to have to use less. They're going to have to be more efficient with their routes of what they do after and before work. People are going to have to work from home, which we've already had a good kickstart there. Maybe the C19 is a good thing in terms of that respect. And maybe we have to do things completely different than what we've been doing. I think that's coming irrespective. So I think that we're going to look at it from an energy efficiency perspective, more so than looking at alternatives and keeping our levels of energy consumption that high. But we'll see. I don't have all the answers. All I have is bringing up what we should be looking at with some of the difficult problems that we need to solve in the future. If you guys like this analysis, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.